Good morning. Thanks for everyone for joining me. I'm Mike Pinggera, manager of the Sanlam Multi-Strategy and Sanlam Real Assets Fund. Hopefully everyone's been sent the presentation pack, so I'm going to try and run through both funds as an introduction. Some people I know will have seen the portfolios before. So if I can ask everybody to turn to slide 5 within their packs. If it's okay with most, I'll skip over the Sanlam part. I'm sure everyone's quite familiar with that. So just a little bit on the multi-strategy team. Actually, there's 4 of us on the team. We've introduced a new member, but he hasn't had a chance to grow a beard yet, so I haven't included him in the pack. For my sins, this is my 30th year in assets management, so I've definitely been around a while. Johan has been with me at Sanlam from day one. We joined Sanlam in 2013. Chris has been on the team for 3 years, and we recently employed another member, Josh Harku, who's come across from Sanlam's pension business. But we're not here to talk about us. We're here to talk about the funds. So turning to slide 6, just an introduction to the multi-strategy fund. It's got a very simple philosophy, and in my 30 years of investment management, almost every client that I've met has a very simple requirement, which is make money. But there's a second part to their requirement, which they often forget to tell you, which is if you can't make it, don't lose it. And that's our philosophy. So to participate when we can, and defend when we need to. So the multi-strategy fund is an absolute return fund. The component parts, we have an equity strategy, we have a fixed income strategy, and we have a real asset strategy. That real asset strategy is available on a standalone basis, which I'll cover as we go through the presentation. We produce returns from both income and capital growth. We have twin objectives. You don't lose money in the short term, and an inflation plus 4% target in the long term. We currently have, in fact, at the start of the month, we had 281 million pounds under management. We're actually now around 310, so we are seeing some very good inflows. The fund is a UCITS fund, so it trades daily. It's available in sterling, dollars, and euros. We hedge currency exposure, so if you're in the sterling vehicle, you're just exposed to sterling. You don't have exposure to foreign currencies. Equally, if you're in the dollar class, you're only exposed to the dollar. So there's no currency views being taken within the portfolio. As it's on the slide, I mentioned that we've done quite well. The fund has won a number of awards over the past few years, which myself and the team are very pleased about. Moving to slide 7, just the key statistics. I've mentioned the asset size is about 300 million pounds. It is an absolute return fund, so the volatility, as you'd expect, is quite low. The volatility is about 3.2%. There is a distribution class available for those clients who want income. And for my sins, once upon a time ago, I was actually head of the trusts and charity business at Credit Suisse, and very aware that clients who require income want that income to be very regular. So in fact, we pay 25 basis points per month, and we have done that every month since mid-2015. So should you have clients who want income, it's good to know that it's monthly and it's a set amount. Performance, the fund has performed quite well. We actually have first quartile performance over 1 year, 2 years, 3 years, 4 years, 5 years, and since inception. So obviously we're very pleased with performance. You'll see on the page slight difference in performance between the sterling class and the dollar class. The dollar class actually has performed slightly better, but that just captures the interest rate differential between the two currencies. We have 98 holdings, 8 short positions, so we are an absolute return fund. 98% of the exposure is base currency. So again, regardless of whether you're in sterling, dollars or euros, it's base currency exposure. And the portfolio's correlation to other assets is quite low. So our correlation to equities is around about 0.5. To government bonds, it's virtually nothing. And even to the hedge fund universe, the correlation is about 0.4. So a very good component of a portfolio, particularly when you're looking for diversification. Turning to slide 8 and just talking about the actual strategies themselves. Essentially, we have three strategies: global equity strategy, which is rules-based, so a systematic strategy, investing in equity indices. We don't invest in individual companies. We're just buying equity market beta. The thematic element of the portfolio is real assets. So here we're investing in physical assets, so infrastructure, renewable energy, specialist property being the main areas. And in the fixed income space, we operate what is essentially a ladder portfolio. Short duration, when a bond matures, we will roll out to the next maturity point. So a very stable element of the portfolio. I'm going to skip slide 9. It's probably something better perused at your leisure. It just shows you the exposures within the portfolio, which is very diversified. And indeed, slide 10 just shows the portfolio evolution over time. It's worth noting when we built the fund back in 2013, we launched the portfolio with our own money. We had a couple of clients who came in, so there was no seed money, and it wasn't actually up until the end of 2014 where the fund went over £50 million in AUM, assets under management, and from that point onwards, the portfolio was really able to access all of the component parts that you see today. And again, the impact that had, just turning to slide 11, my exposure to equities has come down over the period. We've made a much greater use of equity options within the portfolio. So making sure that we maintained exposure to equity markets, but limiting the amount of capital at risk. And obviously within an absolute return fund, and given the backdrop we had over the last 5 or so years, and indeed the backdrop that we continue to see today, we think that equity exposure with optionality is a very sensible way to approach markets. You also see on that chart our exposure to government bonds. We had a long period where we had no government bonds. The yields were very compressed, and even at the moment we actually only have a 2% weighting towards US 10-year treasuries, which is part of the hedging portfolio. It's very difficult to point to bonds as attractive investments when those government bond yields are so low. I'm going to pass over the next couple of slides and perhaps get to the meat of the bone on slide 15. So as an introduction to our real asset component, and within this segment, I'll try and introduce the standalone vehicle as well. So real assets essentially is a portfolio that focuses on what we describe as the pillars of a functioning economy. Just what does an economy need in order for it to be successful? And there's some basics. So education, schools. We need people capable of doing the jobs that need doing. Housing, people need to live somewhere, and transport so they can move from where they live to where they work to where they study. These are just basics. We need energy, we need food, we need water, and we need healthcare. We need to keep people fit and well, and again able to be productive members of society. And at this point, I often talk to the healthcare sector, particularly in the UK. There's lots of talk that the National Health Service is in crisis and it's crumbling. And I think this this misses a very important point. The National Health Service in the UK is in fact the fifth largest employer in the world. It's the US military, the Chinese military, Walmart, McDonald's, and then the UK National Health Service. If the NHS was a country, its budget, if that was a country's GDP, it would rank somewhere between the 50th and 60th largest country in the world. So it's not a problem of staffing, and it's not a problem of funding. What needs to happen in terms of the health provision is it needs to change. It needs to become fit for purpose. It was built 70 years ago. People's life expectancy was much shorter. What we now have is people living longer and hence needing a different type of care. And that shift in the health provision is actually a very attractive long-term investment opportunity for people like me. And we see these pillars as being those pressure points, whether it's the pressures that led people to vote for Brexit in the UK, or the pressures that lead people to vote for Donald Trump in America. It's the fact that getting a house is expensive, is that transport is congested, is that education is very patchy depending on where you live. All of these are pressure points that we see you're driving some of the political moves that we're seeing around the world. And I think it's important that people realize that underlying that ultimately is a demographic argument. We're forecast that by 2050, 1 in 5 people will be over the age of 60. But I think this misses a point. Everyone's quite familiar with an aging population, but in fact, 65% of the world's population is under 35, and we feel it's more important to concentrate on those younger people coming through the system and wanting an education, a house, a healthcare system, wanting clean energy, expecting people to take care of the environment. We think that's where the investment opportunities really come from. And if you turn the page to slide 16, you'll see that every one of those opportunities is analysed by myself and the team. We don't require outside analysts to provide, or brokers to provide input to us. We're more than happy and more than capable of doing the work and finding those investment opportunities ourselves. Now, whenever you've found an opportunity, we create what you see on slide 16, which is a base note. It's a desk note, which for us provides us with the best of our ability at the deepest possible understanding about what the company does, what it's trying to do, the structure of the business, where the opportunities and the potential risks come from. And that base note provides a reference point for us that as time goes by, every new piece of news, every bit of information, every interaction we have with the company, we can refer back to, is this what we thought about when we first identified the company as an opportunity? It also means that every time we learn something new as a team, that knowledge is retained by us, and it enables us to take that new knowledge and compare and contrast with other investments that we already have, and of course with potential future opportunities as well. Within the real asset portfolio, we have 33 holdings at the moment. On slide 17, you should see that we've got exposure to 33 positions invested in 62 different countries and 57 countries and 62 different asset types. So those opportunities, those pillars of a functioning economy that we described, we believe are global opportunities, not just opportunities limited to the UK as an example. When we look at valuations on slide 18, whilst we have seen government bond yields compress, in many parts of the world we have negative yields on government bonds, we haven't seen anything like the same sort of compression in real assets. So in fact, our investments in infrastructure, so again, schools, roads, hospitals, these are actually priced off a discount rate of around about 9%. And that's actually not too dissimilar to the discount rates that they were pricing off back in 2013 and indeed before that. In renewable energy, we're seeing discount rates of about 7.5%. Property has seen a bit more compression. Property is a little bit more traditional than those other real assets, but still property yields haven't reflected the same level of compression that we've seen in government bonds. And indeed, if you turn to slide 19, where we have 4 charts, on the top left of slide 19, you see the real asset betas to equity markets. Overall, the real asset component has a beta of around about 0.3 to equity. So they are equity investments, but they are not highly correlated to the broader equity indices. So again, a very good portfolio diversifier. It's actually been a very, very important component part of the multi-strategy fund. It's been the component part that's delivered the most returns since we launched back in 2013. What we tend to focus on in the real asset space is physical assets with contractual income flows, contractual cash flows, preferably with inflation linkage. And what you see on the top right-hand side of slide 19 is those contract lengths. So we've got a great deal of visibility. In many cases, you're 15 years and beyond. In fact, earlier in the week, one of our investments in student accommodation just signed a contract with Leeds University in the UK, where the university has agreed to take their property, it's 400 beds, for the next 30 years. So that company has secured 30 years of revenue from the university. So very, very, very high certainty of return, which we quite like. Since we launched the real asset portfolio back in August last year, when we launched the portfolio, had a yield of around 4.5%. Now, since we launched, the actual fund performance has been quite strong. The fund is around about 15 or 16% up over that period. Now, one would expect if you had a 16% movement on the price and you started with a 4.5% yield, we should see the yield now down at about 3.8. But in fact, that's not the case. The yield on the portfolio is currently around 4.3%. And this is because the income stream in the real asset investments they're progressive. They have inflation linkage, so they grow over time. So although we've seen a 16% move in capital, we haven't seen the income compress, which again is a great example of showing why we like these assets for the long term. Just turning to slide 20, and as I've mentioned, the real assets has been a component of the multi-strategy fund since we launched. Slide 20 shows you that component carved out on its own. So since 2013, we've had an annualized return of just under 13% per year. That's come with volatility of around 6%, 6.2 to be exact. And the maximum drawdown that we've seen over that period is 4.6%. So when we compare this global equity investment that we've made with global equities, what we've actually seen is very strong performance, low volatility, and much lower drawdown. Now, it's actually that performance that 2 years ago prompted one of the investors in the multi-strategy fund to say, look, I'm very happy with what you're doing in multi-strategy, but the bit that I get most excited about is real assets. And that client said, if I can have the real asset component on its own, I'll give you more money. Now, some of you may know the individual. It's actually Fred White, who runs Sanlam's institutional balance funds. So Fred asked us to carve this element out, which we did we delivered a segregated mandate 2 weeks after that conversation, with the view that we would eventually launch the fund, and that money, that was a £50 million investment, would roll into the fund. If you see on slide 21, the Real Asset Fund became available August last year. We launched with that initial 50 million. We're currently standing at about 209 million pounds. So we have seen very, very strong growth. Quite a lot of that has come through performance, but mostly it's come through new asset flows. And if you turn to slide 22, I just show the performance of the real asset component since we launched. So here you see the segregated mandate from January rolling into the fund. We're actually about 22% ahead of MSCI World since we launched the portfolio. And the performance, the path, the trajectory has been very, very pleasing. In Q4 last year, we saw about a 13% fall in global equities. The real asset fund fell 3%. In Q1, there was a very strong rally, which I'm pleased to say we participated in. In May last year, there was a 6% fall in MSCI World. The real asset fund was up. And indeed, in August, we had another down month for global equities, and the real asset fund was up again. So essentially, what we're seeing in the real assets is a very diversified portfolio concentrated on these pillars as we describe them. You are getting those equity-like returns, those higher returns that people are after, but you're getting that with a lot less volatility and a much greater certainty of return. Moving back, just sort of rounding off the real asset component, I moved back on slide 23 to multi-strategy again. The fixed income component of multi-strategy is essentially a ladder portfolio. We will invest across the credit spectrum, so from AAA bonds through to, at the moment, non-rated bonds. Non-rated bonds, we have one, it's actually Sainsbury's, so UK food retailer, and it's non-rated not because it's a distressed bond. It's non-rated because it hasn't requested a rating from the rating agencies, which of course you have to pay for. So our duration on the bond portfolio is around about 2.2%. Over the last year, it's ranged between 1.8 and 2.3. So low duration portfolio, full spectrum, bonds mature, and we will roll them out. So it's a very low risk, very simple strategy that provides a very solid base for the portfolio. Turning to slide 24, which is our equity strategy. We run two systematic strategies, both which are best described as momentum strategies. So what momentum strategies will do, we will increase our exposure to equities in rising markets, and we do that systematically through time. And we will also reduce our exposure in falling markets. Over the last 12 months, our equity exposure has ranged from 3% at the low to 29% at the high. So you can see within that range, it is quite dynamic. Now, we do tend to use quite a lot of equity options in the portfolio. So as I sit here today, I've got about 15% exposure, net exposure to equities. But I hold call options that would take that 15% to a maximum of around about 35% automatically. So if, for whatever reason, if there was a resolution to Brexit, if there was an agreement on trade talks, if for whatever reason markets suddenly rallied sharply, my exposure to equities would increase automatically. And it's really important to go back to the mandate. My mandate, the challenge that investors have given me, and indeed what investors are paying me to do, is to participate when we can, but defend when we need to. So making sure that we've got that ability to participate on the upside is absolutely mission critical. So although we are very conservative in our exposures, we always make sure that we've got that ability to participate when markets move. Now, the same is true on the downside. I hold put options, so I hold portfolio insurance just in case the worst happens. And as we stand, that 15% would automatically become -3 if there was a sharp sell-off in markets. And it's that blend between a very dynamic approach to our equity allocation, which again, we trade mainly through equity indices, so equity futures, index futures rather than single names. But having that optionality that provides us with the upside participation when it's there, and it gives us the downside protection when we need it. When we combine those slides, those strategies, if you turn to slide 26, hopefully what you'll see is the characteristics of the portfolio. I have a short duration bond portfolio providing income. I have a thematic portfolio of those pillars of the functioning economy, those real asset investments, so schools, roads, hospitals, etc. Again, providing income, and those two components provide a really solid base, a great foundation for the portfolio. Alongside that, I've got that element of optionality to equity. So if equity markets perform, we will participate. If equity markets fall sharply, we will defend. And so what we get left with is what you see on slide 26, is essentially we have a portfolio that looks an awful lot like a diversified convertible. And whilst I'm not a convertible fund, I'm not a bond fund, I do have the characteristics of a convertible. And I think that's actually a really positive place to be. We don't know, nobody does, what the outlook for market is. I don't know whether this year turns out to be a participate year or indeed a defend year. And remember that last year, going into Q4, it was a participate year, and in the fourth quarter, all of those gains were lost. So it's only in hindsight that we can actually make that judgment, whether it was a participate or a defend year. What I can say is that in a defend year, what you really want your portfolio to look like is a portfolio of bonds and real assets. So safe, secure, income-producing assets, not particularly sexy, not particularly exciting, but very, very stable. If things turn out to be much better than expected, then you want that equity participation, which we get through the optionality. Excuse me. So as a combination, trying to deliver that mandate, participate when you can, defend when you need to, the structure of a diversified convertible seems to me to be a very, very sensible way to approach the challenge. Just a point to risk management. It is an absolute return fund. So I'm always very keen that when we make statements to say we're a safe pair of hands, what we actually need to do is show you that there's a process that sits behind that. What you see on slide 28 is just our risk framework. So we spend a lot of time hunting for investments, and we do a lot of work researching those investments to make sure that we understand what we're getting involved with. We get the benefit of a diversified portfolio because we add lots of different assets to the portfolio. But more importantly, what we have to do is really embed those protections. My job and the job of the team is to manage the portfolio, not just construct the portfolio. So we will always employ, as I've described, option protections. We will hold portfolio insurance just in case the worst happens. And that insurance does cost money. But something that often surprises me is that we insure most aspects of our life. We insure our house, we insure our car, we insure lots of things, but many people seem reluctant to insure their portfolio. And portfolio insurance for me just makes sense. We obviously try and keep the cost down. We don't want the cost to become too prohibitive. But having some portfolio insurance for us it makes absolute sense when your mandate is absolute return. We also run a stop loss process, and that stop loss process is there so that no investment is ever there for falling in love with. We will be very disciplined. If a position starts to lose money, we will review it, we will reduce it, and we will ultimately remove it. But we will never allow any position in the portfolio to blow up on us. Stocks and shares are for buying and selling. And we have to have processes within the portfolio where we can check that. In fact, on slide 30, you can actually see that stop loss process in terms of the metrics. Now, I should point out that this is it's a control process, so it's overseen by my risk committee and by the management committee. So although myself and the team built that process, that's actually a process which really does have teeth. And every stop loss that we've hit since we launched the fund back in 2013 has been followed and documented. So it's a completely transparent process. And the way we look at that stop loss is we just assume the worst case scenario. We assume that every single asset we own in every market, every asset type goes down. So we are losing money everywhere, but we action our stop loss process. Level 1 is it's optional, so we don't have to action level 1. But level 2 we will halve the exposure, and level 3 we close the position out. So if we action level 2 and level 3, the downside risk to the portfolio as of today is around about 7.5%. Now that would mean that we would be 100% cash, which over the years when I've said that to people, occasionally people sort of react and say 100% cash. It's a big position, but just remember that what that means is when you're losing money everywhere, you're losing money in government bonds, in corporate bonds, in equities. You're losing money in infrastructure. You're losing money in renewable energy. You're even losing money on your put options. You just assume you're losing money everywhere. In that environment, holding cash actually seems the most sensible thing to do. Now, it's very extreme, and it actually hasn't happened. We've been about 60% as the highest level. But in the most extreme, given that my task is ultimately to protect investors' money, then we absolutely have processes that would lead us to cash. On slide 31, you just see the drawdowns. In fact, the portfolio since we launched has consistently had much lower drawdowns than investments in equities, and indeed equities in bonds. So our diversification, our stop loss process, and our use of portfolio insurance put options has worked really well. I said it's a slide you can peruse at your leisure, but whilst we've had that upside participation, we've also had the downside protection. Now, if I may, because I think it might be quite interesting, I think perhaps if I ask you to wind forward to just a couple of the case studies, which is a long way forward in the pack. But slide 53, I think, is a very interesting page to look at. And this is just a little bit of a window into what we're doing within the real asset space. Greencoat is a UK renewable energy business. They invest in wind farms. They came to the market back in 2013, where they raised an initial amount of £230 million. Now, I'd known the team for a couple of years before that, and we were willing to invest with them to get this new vehicle off the ground. And it's worth noting that this is essentially a listed private equity investment. If you're investing, if you were Yale or Harvard, if you were one of the big endowments, you'd be investing in private equity directly. But of course, you have to lock up your capital for a very long period of time. And every time there's a capital call, every time there's a new investment, they draw down on your capital and you are on the hook. In the case of listed private equity, in the example here of Greencoat, they originally raised 260 million. Since 2013, they've actually come back to the market on 10 occasions for fresh capital. And we've been very pleased to support that growth in the business. They now have a market capitalization of over £2 billion. They've seen significant outperformance of UK equities. And it's worth noting, particularly in an environment where topics such as ESG, impact investing, ethical investing, green investing has become very, very topical. I always feel it's important to remind people that if you're only trading the secondary market, if you're only trading shares in companies secondary, you're actually not putting any fresh capital into those new technologies. Where we sit in the real asset space is we are very active in the primary markets. So we are putting fresh capital into developing renewable energy solutions. We're putting fresh capital into developing educational facilities, fresh capital into assisted living, social housing. And that fresh capital is incredibly impactful. Now, we're not mandated to be an ESG fund or an impact fund, but if you place the pillars of a functioning economy at the heart of your process, then it's actually quite hard to destroy the world. And we've come at that purely from an investment perspective. We think those investments are highly attractive, but they're also very, very targeted to the current themes, I said, around impact investing and ESG. If we turn to slide 56, just as another very left field example of the types of assets that we invest in, slide 56 is a company called Hypnosis. Now, Hypnosis is in fact the first listed vehicle to invest in music rights. So Hypnosis owns the writer's share of over 6,000 songs. Now this means that every time a song gets played, and you can see some of the examples on the screen. So Umbrella by Rihanna and Single Ladies by Beyonce. I have been known to sing a few of these once in a while, but I'll save you the pain of hearing me do that now. Every time one of those songs gets played, every time it gets streamed, every time it gets downloaded, we get paid. If Robbie Williams chooses to sing a cover version of Otis Redding Sitting on the Dock of the Bay, we get paid. It doesn't matter who uses it, we get paid. Now, the writer's share of a song lasts for 70 years after the death of the writer. So what we've got is a very, very long life asset. We're seeing massive growth in subscriber numbers. So from 2015 onwards, music streaming is forecast to grow by 900%. It doesn't really matter what Donald Trump tweets. It doesn't matter what Brexit is or isn't. People jump in the car, they turn the radio on, they hear Smooth by Santana, and we're being paid. Now, just pull out one song, just an example of where the opportunities lie. The portfolio that contains Single Ladies by Beyonce, that was purchased for $4 million now 2 years ago. So we get the rights to that catalogue for the next year, at least the next 70 years. That was a $4 million portfolio. That song, though, Single Ladies, was used in an advertising campaign in America, and the company used it for their Christmas marketing, and they paid $1 million to use that song for their Christmas campaign. So one synchronization deal returned 25% of the total capital outlay. So it's a very, very dynamic space, and something that again, it's our task as fund managers to go and hunt for these new ideas. And so when you consider that 65% of the world is under 35, and indeed 65% of the world already have access to the internet via a mobile phone, we think investments such as music rights are very, very interesting. So I'm going to wrap up the day, and again, I think there's the forum for asking questions afterwards. I'm more than happy to answer them. But essentially, myself and the team run two funds. We have an absolute return fund, the multi-strategy fund, which is exactly what it says on the tin. It's designed to participate when we can and defend when we need to. Within that, there is a component called real assets. the real asset component is also available on a standalone basis, but it's not an absolute return fund. It's a long-term, thematic, in effect, private equity growth portfolio. Both funds trade daily. Both are available in sterling, dollars, and euros. I think as part of a portfolio solution, they both definitely can be considered for a place, but they do bring quite different opportunities between themselves. So with that, I'm going to thank you for your time, and as I say, I'm open to questions going forward if anybody has any. Thanks. So I can see a question has come in, and despite the fact I'm wearing glasses, I will have to sit forward to read it. A question has come in that says, which type of client is suited to which type of portfolio? So we have a very broad spread of investors within both strategies already. The multi-strategy fund, depending on the client type, we have pension funds invested, we have charity clients invested, we have individuals invested, we have offshore private banks invested, we have wealth management business invested. So it's a really broad spread. But that doesn't particularly surprise me, because the mandate that we built, you participate when you can, defend when you need to, I think does cover a very, very broad church. What we have found is that the pension clients, certainly clients in DC schemes, so defined contribution schemes, view the absolute return fund as a diversified growth fund. In the private client space, particularly within family offices, it's often viewed as a liquid hedge fund. It's not a hedge fund, but the nature of the portfolio and the profile, it tends to fit into that camp where people want hedge fund-like exposure, but of course it trades daily. There's no performance fees. And then in the wealth management space, both the real asset fund and the multi-strategy fund are very much a diversifying component part of the portfolio. One very interesting characteristic of the real asset fund is that as it's a global equity investment. So many clients have quite a small allocation to alternatives within their benchmark. And in fact, this was the case for the original seed investor. An allocation to alternatives was an off-benchmark position, whereas an allocation to real assets was an allocation to global equity. Now, in fact, that global equity allocation comes with a very low beta to the market. So it's a really good portfolio diversifier, but it is global equity. So depending on the mandates that you have or your clients have, it may mean that you've got a greater capacity to own real assets in your equity component if you've got a smaller allocation to alternatives. But in terms of client type, which was the original question, we actually have a very, very broad spread of clients in terms of client type, currency, and indeed geographical location. It doesn't look like we have any more questions coming in. So once again, thanks for your time. And as always, if there are any questions afterwards, just reach out to myself or any of the Sanlam team. Thanks again.